Advanced Financial Accounting Excel Practice Problem. In this presentation, we're going to go through a practice problem in Excel related to a consolidation where we have a parent-subsidiary relationship, the parent owning over 51%, having therefore a controlling interest, but not 100%, so we will have a non-controlling interest to deal with. The major focus of this problem will be on preferred stock, some owned by the parent and having a non-controlling interest with the preferred stock as well. Get ready to account with Advanced Financial Accounting. Here we are in Excel. We have our information on the left-hand side. We're going to be entering that into the blue area on the right-hand side, including our worksheet and our consolidation worksheet. The consolidation worksheet having the information for both P, the parent, and S, the subsidiary trial balances we will be consolidating together. Let's go back to the information all the way to the left where it says P, the parent, owns a percentage of S, the subsidiary, that percentage being 90% on the common stock, 60% on the preferred stock. Now, obviously, the common stock is the stock portion that's going to give us that controlling interest of voting stock. The 60% on the preferred stock is going to kind of muddy the waters for us to consider the elimination entries and the investment in S by P, how P is going to be recording the investment. So the purchase as at book value on January 1st X0. So that means it was purchased at book value. We don't have that differential we'll have to deal with. So that's going to be nice. The fair value of the non-controlling interest in S, common stock is 10%. So that's the 90-10. S preferred shares, annual cumulative dividends, 7.5%. And then on December 31st of the current year, dividends were declared and are paid on January 1st of the next year. So that means we're going to have an intercompany receivable payable with regards to the dividends that we'll have to deal with. Okay, so then if we think about our worksheet, let's take a look at our worksheet first. We have P's books, we have S's books, the trial balances for the two. We're going to do our standard process, which is to add them up. So we'll sum them up equals the sum of these two. I'm going to then copy that and paste it on down, which is summing up and adding up the column. So there's going to be our starting point, our total column. Now we got to think about, all right, how is P reflecting the books of S? So in essence, here's the assets minus the liabilities. Here's the equity in S, the 603,375. How is P reflecting that using their basically equity method over here? And then when we do our elimination entries, then how can we use that information in order to enter the elimination entries? Now, the new things that are kind of muddy the water here, we always had this investment in S common stock, but now we've got the investment in S preferred stock here. And then if we go down here, of course, we've got the preferred stock that's going to be on the books for S that we're going to have to deal with. We have the dividends as well, the dividends not only on the common stock, but the dividends on the preferred stock. And then P is also recording this dividend income for the preferred stock. So these are some added components that we'll have to think about. And that first journal entry, in essence, is going to get longer here. So let's go back over here and let's kind of recalculate our equity section calculation and see if we can help ourselves out with that first journal entry. So first, we can think about the equity section here. It's going to be the assets minus the liabilities. That's the 603,375. Let's go ahead and recalculate that basically in a table format. So if we were to kind of think about this in a table, we could say, well, we have the beginning book value, and the beginning book value is going to be for the preferred stock, is going to be this item. We're taking just basically the equity section. The common stock is going to be this item. And then the retained earnings, the beginning retained earnings is this, because that's what it is before we close out net income or any dividends into it. So notice we have a separate account for the dividends here. So they're not just included in the retained earnings number. So that means that this number is the beginning retained earnings. So that's going to be basically our starting point. If we were to sum those up, that would be like the equity section at January at the beginning of the year. Then of course we'd have the net income that's going to happen. The net income is going to be this number down here, which is revenue minus expenses. So that would be going into the retained earnings in terms of our equity section. So I'm going to say that's going to be the retained earnings. And then we're going to have the preferred stock. Preferred dividends, the preferred dividends, that's going to be decreasing the retained earnings, just like our calculation when we just summed it all up here. That's going to be decreasing our retained earnings. So I'm going to be putting this in as a negative of that 13,125. And then we have the common dividends, and that's going to be this 9,500. So I'm going to be picking up the 9,500 for that one. That's going to be then the activity there. Then on the common stock side of things, we had the... Actually, no, that's it. Hold on a sec. Let's go ahead and sum this up then. We're going to sum it up this way. We'll sum it up on the horizontal. I'm just going to sum them up individually to emphasize what we're doing. You can copy and paste the formula down. Be a little faster. And then we'll bring in the ending. This will be the ending book value. And I'm going to then sum them up this way. And again, you can copy them across. I'm going to do them individually just to emphasize the summing process that's taking place here. Summing process being emphasized. Oh, that's too high. Okay. So there we have it. And there's the 603 375, which is the assets minus the liability. Assets minus the liabilities being not there, here for S, 603 375, and the equity being the 603 375. Now we're also going to think about that in terms of P's investment. You know, can we break that out in terms of the investment? So we'll do the same calculation up top here, and we'll come up to that same 603 375, which will help us out with our first journal entry. To do that, let's go down here to these worksheets down here real quick. We will now calculate the beginning book value of the non-controlling interest. So we're thinking about this number here. We're thinking about basically the beginning number here. And then we'll use that in our worksheet up top for our beginning number to then calculate what the ending number for that non-controlling interest in NA will be. So let's first think about this in terms of, we're going to say, all right, the common stock of S. And I'm going to say this is going to be, I'm going to be adding up the common stock and the retained earnings for these items, okay? So I'm going to be, and these are the beginning retained earnings, you'll recall, because nothing's been closed out into it. This is coming from the trial balance. I'm going to say negative sum of the common stock and the retained earnings. And then I'm going to take the preferred stock of S, and that's going to be equal to the preferred stock up here, which is going to be the 175. Now the non-controlling interest then would be the 10%, so 10% for the common stock interest, and then we're going to say equals 1 minus the 40, or of course, or I'm sorry, 1 minus 60 or 40% being for the preferred stock. So multiplying that out, then we're going to say, okay, there's that 340,000 beginning balance times the 10%. There's the non-controlling interest. There's the 175,000 times the 40%. There's the non-controlling interest. So this will be then I'm just going to retype the title here. Beginning book value that's it. That's the one. And then let's go ahead and just sum up this outer column. All right. And that's going to be basically going up top into our first number here, where we have we're going to call this the beginning book value, and this is going to be equal to that 104. So we're going to use that number there. Now we'll also need the net income, but the net income is going to be a little bit confusing because of how we're going to allocate it due to the preferred stock. So we're going to say, all right, let's take a look at net income. Let's break down net income in a table down here. Net income, we could see over here, is the 111. So that's revenue minus expenses for S, straightforward net income right there. So we're going to be starting with that 111. But then we've got these preferred stocks, preferred dividends, preferred dividends. And they get paid out first, right? Because the preferred people get paid before typically the common stock folk. So therefore, we got to remove the preferred dividends. So we're going to say, all right, the preferred dividends were this 13. So I'm going to say Let's remove the 13,125 for the preferred dividends, and that's going to give us the net income after preferred dividends is going to be the sum of those two, let's say. Let's put a little underline on this one for some formatting purposes. And then we're going to break that out between our percentages. We're going to say, all right, now let's take that number times, for P's, the controlling interest, 90%. And then let's take that number times S's non-controlling interest, which is the 10%. Now, I also want to consider the preferred dividends for the non-controlling interest. And we're actually going to say that the preferred dividends for the non-controlling interest being the non-controlling interest portion of that 13,125. So we're going to take that 13,125 times the non-controlling, or 40%. So I'm going to say, let's take negative of that number times, I'm going to say, let's call it 1 minus that 60%, which is, of course, 40%. And so there's the 5120, and that's going to give us the net income for the non-controlling interest, which is going to be the sum of these items. So those are going to be useful. We're going to need those items for our table up top. So now let's go back to our table up top. And so now we're basically going to reconstruct this number, which is the equity of S. And we're going to do so using P's accounts, what they put in place with regards to the equity method. So we're going to be thinking about, all right, this number here, this is P's investments in S being recorded using the equity method, and this number down here to see if we can then come back into this, this equity calculation, which will help us with that first journal entry. So we've got the book value. The book value here. Let's look at the non-controlling interest. So we got the non-controlling interest. So then I'm going to go to the net income on here. So this is going to be the beginning balances. We want to then get down to the bottom here, which is going to be the ending book value. So this is going to be the beginning numbers. Then we would have the net income, the non-controlling interest on the net income. We calculated that down below. Notice what we did here. We took the net income minus the preferred dividends and then broke them out. So, but I'm actually going to break out the net income and then put the preferred dividends here. The preferred dividends. So what I'd like to do then is pick up this number before we take out the preferred dividends. So then we got this number that already has the preferred dividends removed, S's the non-controlling interest portion. So then we add those back in, and we're going to be using then this 15,038. So I'm going to say, all right, this is going to be the 15,038, and then we'll take out the preferred dividends, which is going to be a reduction of the non-controlling interest, which we calculated down here at the 5,250. So we'll take out, now I'm going to make that a negative to take it out, minus that. And then we've got the common dividend. So this is going to be common dividends, common stock dividends, which you could see the dividends over here that were given for the common stock. So this is the total dividends, non-controlling interest portion, 10%. So I'm going to do that with a little calculation. So we'll say we're going to take that. That's going to be a negative because I want to make it a negative number here of the 9,500 times the 10% for the non-controlling interest portion. There's the 950. Let's go ahead and sum this up then. We'll sum that up. So there it is at the 112,838. So that is what basically this number will be, right? That's going to be this number, the non-controlling interest portion of the, in essence, equity section here. So now we'll take a look at controlling interest kind of section or components of it. Next item is the investment in the preferred stocks. The investment in the preferred stock is going to be this item here. There's going to be no change to it, so I'm just going to pull that in. So we're going to say this is going to be the 105,000. No change to it, so we're going to say that's the beginning and the ending balance, both the beginning and the end. That's the beginning and the end. So then we're going to take the preferred stock dividend income. We have the preferred stock dividend income here. That's P reporting their dividend income from S for the preferred stock. Then on S's side of things, if we go over to S, they're going to have the dividends, preferred stock dividends here, or you can calculate them as obviously the preferred stock times the percentage. This is the dividends that went out. You'll note down here that in calculating the allocation of the net income, we took out the dividends. So we're going to do a similar, just a netting process in this column. We're going to say this number needs to go off, and we're going to basically net that out into the net income column. So we're going to say, all right, for the net income, I'm going to calculate it this way. I'm going to be picking up the preferred dividends and then taking the portion that is P's, that being 60%. So there's the 7875, and then I'm going to take the preferred dividends, which are recorded down here. I'll keep it as a negative. I'll pull the same number from here to see those basically net out. So bottom line will be 0 at the bottom. Okay, and then we have the investment in the common stock. We're basically going to be reconstructing this number, this 385,538. So to start off, I'm going to take the beginning balance portion of basically the common stock portion, which is going to be the common stock and the retained earnings, and the beginning balance portion being the 90% controlling interest of that. So I'm going to say, all right, then this is going to be the negative sum of these two items, the common stock and the retained earnings, closing that up, multiplying it times the controlling interest, that 90%. So there's the 306,000. So then we want to take, before we do, let's actually add this up this way, just so we can see it this way. If I sum these up, we're going to get to the 515, that being the beginning balances, which if I take the preferred stock, the common stock, and the retained earnings, that's the 515 before we close out anything to it. So then on the net income side of things, so now I'm going to go to the net income, and that is going to be including, notice down here we did our calculation where net income, we took out the preferred dividends and then broke them out between P and S, controlling, non-controlling interest. That's what we want to take out here. This is going to be the 88,088. And then note the net income, the total net income, if we were to add this up, is going to be equal to the net income down here, the 111. So notice this net income is netting out the portion that was for preferred dividends, and then the preferred dividends for the controlling interest is added here. And this one actually includes the non-controlling interest, the preferred dividends, and then the preferred dividends are taken out here. Okay. So then we're going to go to the, if we add up the preferred dividends, we're not going to put anything here for the investment, but if I add up the preferred dividends, just note that that adds up to the 13,123, and that's going to be the 13,123 on this side of things. Then we're going to go to the common stock dividends for the controlling interest. So I'm going to say negative. We're going to be picking up the common stock, which is the 9,500, multiplying that times the controlling interest, that being the 90%. And there we get the 8,550. If we sum this up, then we're going to get to that 9,500. So there's that 9,500. Then we can sum this up vertically. So we'll sum it up vertically. And that's going to give us our 385,580. So there's going to be our 385,580. There's our 105 that we basically reconstructed here. Then we can add these up either this way or this way, and we should get to, either way we do it, that 603,375. So let's vertically add them up. So we're going to get that 603,375. If I add them up this way, we get the 603,375. That, of course, equals the equity section here, or assets minus liabilities, 603,375, or, of course, all of the equity in this way, 603,375. Now, let's do our elimination entries. Let's go through our elimination entries process. So basically, of course, we have this item we're going to have to eliminate. We're going to have this item we're going to have to eliminate in our elimination process. Those two are going to need to go to 0. Let's get back to those in the future, however. And let's go through the equity section just as we normally always do, right? So we're going to say here's S's equity section, which we basically have to remove. We just have a few other kind of components here in terms of the preferred stock to remove in them. So I'm just going to say, all right, well, here's credit balance for the preferred stock. I'm going to take that and we will debit it. We will debit it to remove it. And then we've got the common stock has a credit. So we're going to take the common stock, do the same thing for the common stock, picking up the common stock, and it has a debit or a credit in it. We're going to do the opposite thing, debit to remove it. Then we have the retained earnings. So we'll pick up the retained earnings. It has a credit in it, so we'll do the opposite thing to it, debiting it to remove the retained earnings. Then we've got the dividends, including the preferred and common dividends. So we're going to take the dividends for the preferred stock. It has a debit in it, so we're going to do the opposite thing to it, a credit to remove it. And then we've got the dividends on the common stock, which also has a debit in it. So we need to do the opposite thing to it, which is a credit to remove it. So that's going to be our standard kind of process. Then typically the next thing we need to remove is this income from S. So I'm going to just pick up that income from S. So we'll pick that up. And normally we've been doing this. We've been saying, well, normally I would calculate this at that 111 times and then be picking up the 90% of it. 90% of it and picking up this number. But the preferred stocks kind of muddy the water in order to do that now. So what we will do instead is simply, in this case, pick up the full amount, and you can see it kind of in the table here. So we're picking up kind of this amount in the table or the full amount down here. I'll pull it from the table. So I'll say pull that from the table. Let's go ahead and highlight this, make it green, just so you can say, hey, we pulled that from the table. It won't let me right click. I'll make it orange. We'll make it orange. So that came from the table. And then we've got the next item will typically be, well, we have to go to the dividend income here. It's going to be another new item for the preferred stock. So that needs to go off the books because that's income from preferred stock. So once again, we could just take that full amount off the books, or you might think of it as coming from the table up top. So I'll think about it as coming from the table. So I'll say this is there. We've reflected that on the table here. So let's go ahead and make that yellow. So I'll make that one yellow from the table. Okay, and then the next item that we typically deal with is the net non-controlling interest. So let's go down to the non-controlling interest of S. And normally this one would be a credit. It would be a debit normally of that 111,000 times the non-controlling interest percent, which would be the 10%. Yeah, so but then again, this one kind of gets a little messed up here because of the preferred stock. We're going to pull this from our table, and it's going to be this net income right here. So that's the net income we're going to be pulling. Going to make that another color. Let's make it blue. Let's make it blue. And then we'll pick that number up over here, 1538. So there's the 1538. Next, we typically have the non-controlling interest, in the net assets. So let's make this blue too, because it's blue over here. So, and that's usually calculated. It's something like this, negative sum. That's how we've usually been calculating it, right? Negative sum of the assets minus the liabilities. And then multiplying that times the non-controlling interest percent, which would be that 10%. Let's do that one more time. Equals the sum of the assets minus the liabilities, close it up, then times the non-controlling interest, or 10%. And it would normally be a negative number or a credit here. So, but we're going to change that one up. That's going to be adjusted to in accordance with our table. So I'm going to be picking that up from the table, and that's going to be this number. So let's go ahead and change that. I'll kind of make that a color-coded item. Color-coded. I'm running out of colors here. Red seems very harsh. We're going to go to this one here. It's not like it's wrong. Red would think like it's wrong. That's what I feel like. So then I'm going to go up top. We've got the investment in S's common stock, which again normally would be negative sum of this minus this, assets minus liabilities, times the controlling interest, or 90%. But again, that gets muddied up because of the non-controlling interest there. So therefore, we're going to pull that from the table, and that's going to be this number, which matches what's in there right now. And then I'm going to make that another color to indicate it came from the table. Let's make it like a light green. Light green. All right. And then we got the investment in the common stock, which is here. Or again, you could pull that from the table as well. And that's going to be the 105. The 105, maybe I should pull it from the bottom of the table. The 105. Let's go ahead and make that one other color. I just need one more. Give me one more option here. Light blue. Light blue. Let's do that one. Light blue. So there we have it. Okay. And that should put us back in balance here. So that should put us back in balance. So that looks good. So let's go ahead and post this thing out. Let's go ahead and post it out. We're going to say, all right, this first one is the investment in S preferred stock. So that's going to be down here. We're going to say that's going to be equal to then that 385,538. That'll bring it down to 0 or 1. It's rounding. So I'm okay with that. Hopefully you're okay with that too. It's not going to disturb you. You'll be able to sleep at night, even though there's a $1 difference. And then we're going to go to the 105,000, 105, there it is there. The preferred stock is going to be down here, preferred stock, and the 175. Let's go ahead and remove that one. Then we've got the common stock. So the common stock, these are bringing the S's portion of basically the retained earnings stuff down, leaving us with, in essence, the parent portion. Then we're going to be bringing down the retained earnings. Let's pull that one over here. Then we've got the dividends for the preferred stocks, dividends on the preferred stock. Next, we have the dividends on the common stock, dividends on the common stock. Then we've got the income from S, that's going to be down here. So that one should go to 0. So this is going to be pulling that one down to 0. Then we've got the dividends on the preferred stock. So that one needs to go away because it's going from one to the other, so I'm going to be removing that. Then we've got the non-controlling interest in net income down below, so we'll be pulling that in. Non-controlling interest in the net income. And then we got the non-controlling interest in non-controlling interest net assets. We'll be pulling that. You might say it's not applicable. No, that stands for the net assets. So then we have this payable and receivable you can see right here, and that's because the dividends were issued but not, but they weren't issued. They were declared but not issued yet. So therefore we have this receivable and payable. We got to reverse that out. So that'll be a simple thing, but that's the main journal entry of this problem. And so again, you probably want to just mull over these tables and consider how the preferred stock basically alters our adjustment here. Okay, so then we're just gonna say, all right, well, that's the second piece over here says the S preferred shares were 7.5 of the dividends. They were declared, but not paid until the next year. So that resulted in this dividends receivable that we got to remove and the dividends payable that we're going to remove. Now we're only going to remove the portion that's intercompany, that being this 7,876. This is all the dividends because we're only removing the intercompany items for them. Okay, so typically we're then going to say the payable is overstated. It has a credit balance, so we're going to go ahead and debit it. If we wanted to recalculate the dividends, just to calculate them for this problem, it would be negative of the preferred stock here times that 7.5%, that would be the full 13,125. And then if we take that times the controlling interest or the 90%, that'll give us not the 90, that's the common stock controlling interest times the 60% controlling interest. There's the 7,875. And then the other side is going to go to the receivable. The other side going to the receivable. Dividends receivable. So let's go ahead and post that out. Here's the payable. So payable is going to be going down for the dividends payable down to 0. Or not to 0. It's going to go to the amount that's not the intercompany dividends. And then the dividends receivable will be going down to 0. So dividends receivable will be this. Okay, end of the day here, we're going to say that couple check figures. You can say, well, these two need to be to 0. That looks good, close enough. One rounding error, we're okay with that. And then we got the equity method. Here's the equity section. We're basically removing S's components of them, leaving us in essence with P's equity here. Then we've also removed the income from S and any dividends from the preferred stock that are the intercompany dividends. Just a couple check figures to check out before completing it.